Chapter 22, Profit Sharing Plan. True, false. Question 1. Employees who take out a loan from their profit sharing plan must pay 10% of the loan amount as a penalty, as well as a reasonable interest on funds borrowed. The answer is false. There is no penalty for taking a loan out of the profit sharing plan. However, there are rules that must be followed, and yes, there must be reasonable interest paid on the funds borrowed. Question 2. In a profit-sharing plan, forfeitures may be reallocated or used to reduce future employer contributions. The answer is true. According to the regulations, that is proper. Number 3. If an employer has a profit, at least some contribution must be made that year to the profit-sharing plan. That is false. There is no requirement for profits to be shared. Question 4. In a profit-sharing plan, it is common to use participant-directed investment, meaning accounts can be invested at the participant's direction. The answer is true. That is the advantage of a profit-sharing plan. Question 5. A standalone profit-sharing plan, where the employer has no qualified defined benefit or other plan, is often integrated with Social Security. That answer is true. That is a means by which the employer can give additional monies to highly compensated employees and at the same time reduce the cost of the profit sharing plan to the employer. Multiple choice question 1. Which of the following provides the greatest amount of flexibility for employer profit sharing plan contributions? Well, anything which would be discretionary would provide the most amount of flexibility. So the answer is A. Question 2. Assuming a plan remains qualified, on which of the following amounts are income taxation deferred? 1. Employer contributions. Yes, that is true. 2. Forfeitures added to the participant's account. Yes, those are deferred from income taxation. 3. Investment earnings on the account. They are likewise deferred. They are not taxed when earnings occur. And number 4, capital gains realized in the account. That is true. There is no gain when capital gain is realized, only upon when funds are removed from the account. So the answer is D, 1, 2, 3, and 4. Question 3. Qualified plans require that the purchase of life insurance be governed by what are described as incidental limits. What is the limitation on purchasing life insurance in a profit-sharing plan? And the answer is B. All amounts that have been in the plan for at least 2 years may be used. So the thing to remember is that within 2 years, that may be used for life insurance. An advantage of a profit-sharing plan from the employer's point of view includes which of the following? A. Employer contributions to the plan are discretionary. That is true. B. Plan can benefit long-term employees. That is true. C. Invested benefits can be reallocated to remaining employees. Correct. D. Allows integration with Social Security. That is true. So the proper answer is E. All of the above. Question 5. A disadvantage of profit-sharing plans is that A. Employee bears the investment risk. That is true. B. Actuarial costs make the plan expensive to administer. No, that's false. There are no actuarial costs involved. C. There is no predictable level of employer funding under the plan. That is true because it is up to the employer whether they wish to contribute to a profit-sharing plan. Therefore, the correct answer is E, A, and C. Question 6. Which of the following are true regarding vesting and profit-sharing plan? A. Forfeiture reverts back to the plan. That's true. Does not go with the employee. B. Plan forfeitures can be reallocated in proportions that favor owners and other highly compensated employees. That is correct. Vesting provisions favor long-term employees. That is not correct. vesting is very sacred with ERISA, and it is not appropriate to favor long-term or any employees. So the proper answer is E, A, and C. Question 7. If employer contributions to a profit sharing plan are based on a discretionary provision, all of the following are true except A, the employer can determine each year the amount to be contributed. Well, that's true. The employer can omit a contribution. That is true. If too many years go by without an employer contribution, the IRS will likely claim that the plan has been terminated. That is true. When a qualified plan is terminated, all non-vested accounts in participants' accounts are forfeited. That is not true. If the plan is terminated, all non-vested amounts actually go to the participant. Therefore, D is not correct. Question 8. Many plans allow distributions early in all of the following cases except, well, home repairs, that's appropriate. Educational expenses, that is appropriate. Purchase of a car, no, that is not appropriate. And medical emergencies are appropriate. So the answer is what is not allowed would be purchase of a car. Question number 9. Stop the recording while you read the question and then choose the appropriate answer. Please pause the video now. The question asks, which of the following retirement savings plans is best for Evergreen? Evergreen is young and innovative, only 25 employees, young, between 24 and 35 years of age. Turnover is low at only 2% for the 9-year-old company. Profit has been intermittent. Therefore, what gives them most flexibility is the profit sharing plan. So the answer is E. That is best for the company. Question number 10. Read the question, select the best answer, and pause the video now. If John withdraws $7,000 from his profit sharing plan, what is true? A, he is in big trouble because withdrawals from a profit sharing plan are not allowed by law. That's not true. They are allowed. He must pay income tax and a 10% penalty on the amount withdrawn. That is not true because of E, he would pay income tax, but no early withdrawal penalty to the extent the medical expenses are tax deductible. One will always pay the income tax. However, it's questionable whether the 10% penalty applies based on the exclusions. In this case, because they are medical, to the extent the medical expenses are tax deductible, he will not pay 10% on that. Question 11. Read the question now, choose the correct answer, and pause the video now. Sandy's share this year will be, well, Sandy earns $40,000 per year. The company will contribute 10% to its profit sharing plan. The payroll was $120,000. This year, Tropical Tours will contribute $21,000. Therefore, $21,000 divided by $120,000. Correction, $40,000 divided by $120,000 is 1/3 of the payroll was Sandy's. Therefore, 1/3 of the total profit sharing, or $7,000, will be paid to Sandy. The answer is C. The fact that they said 10% of profit is paid, it could have been 50% or 100%. We know that Sandy's $40,000 is 1/3 of the total payroll. Therefore, Sandy gets 1/3 of what was contributed to the profit sharing plan, which was $21,000. So 1/3 of $21,000 is $7,000. It happens that $21,000 is 10% of the profits, but it could just as easily have been 60% of the profits. Question 12. Read the question and select the best answer, and pause the recording now. So in this question, we're using the number of units based on annual compensation and based on years of service. This is how a unit-based plan would give more allocation to older employees. So they're asking how much would be allocated to TL's account if he received 40 units of credit for his years of service and 160 units for his earnings. So he receives 40 plus 160. He receives 200 units. If all the units for all employees is 1,000 and he has 200, he receives 20% of whatever's put into the annual contribution. And 20% of $20,000 is C, $4,000. So this is the situation where by doing units based on years of service, more money can be allocated to the older employees.